Welcome back to Beyond the Wrench. My name is Jay Goninen, and I'm your host. Today, we welcome back a now recurring guest, Cole.strandberg. You may know Cole from his incredible podcast, The Collision Vision, or from his role as principal at Focus Investment Banking. Cole's understanding of the business landscape for collision shops is very deep, and it's why every time we talk, I come away learning something, and normally it's a lot. And the other thing I'll mention is I was just at the Southeast Collision Conference with Cole a couple months back, and Cole is an actual celebrity. When we were walking around the conference, everybody knows Cole, and Cole's a great connector of people. So welcome back to the show, Cole.
Thank you so much for having me. It's always a blast to connect, and especially connect when we're recording and magic happens.
Yes, it does. And I was fortunate enough to just be on your podcast yesterday. So it's always fun to do kind of the exchange of podcasts. And again, I think we're going to learn a lot today. And what our topic of today is talking through a presentation you had recently given at CCA, the Carolinas Collision Association. Can you talk to me a little bit about what that presentation was about?
Yeah, absolutely. Essentially, we spend a lot of time talking about consolidation within the collision repair space. And I wanted to sort of flip the script on this one and really dive into not only selling as an option for your collision repairer's future, but talk about three options based on kind of where we see the industry going. That came together, the CCA presentation at the Southeast Collision Conference that you referenced. I'd be remiss not to point out your presentation at that conference was absolutely fantastic. And it was the basis for our podcast yesterday on the Collision Vision. So always a good time.
Yeah. And as we dive into this, I think one of the things that stands out to me is Cole is very familiar with the collision side of the industry. A lot of the principles that he is going to talk about will apply to other segments, right? It might be something with the repair side. There's always something you can learn regardless of what type of business you're in, but this will be focused on the collision side of the business. And the reason I say that up front is because I think you're doing yourself a disservice if you hear that it's on the collision side and don't listen to the entire thing, because there's going to be a lot that we're going to talk about. And we're going to start right off with a hot take that you have, something that might be a little controversial, but I also think it's a great starting point to our conversation today. Can you talk to us a little bit about something that is maybe a little controversial?
Yeah, absolutely. In my line of work, in your line of work too, it behooves us to not be controversial, right? We want to be friends to all. There's no point in making enemies. So it's controversial, but I'll tell you why it's really not too. But my thing of late is acknowledging that the era of the single store generalist body shop is coming to an end. It's expensive to equip shops appropriately. It's very challenging in all of the automotive aftermarket right now to find technicians. The training's expensive. These vehicles are getting more and more complex seemingly every day, and we're no longer able to get that margin as a single store on the collision side, or even more importantly, safely repair these vehicles without a ton of investment. So there's some negative tail headwinds, I guess, in this case. However, anytime you have negative headwinds, you can kind of flip the script and get some really powerful tailwinds out of that. And I think that's the case here.
So as we talk about that, it doesn't necessarily mean that it's a negative thing, right? I think a lot of times when this topic comes up, there can be kind of almost this defensive,ness or maybe a reason why somebody might take offense to it, but that's not the intent. Like, we're here to educate and really try to help that shop that's out there truly understand what their options are and really what they need for their vision moving forward.
Exactly right. Challenges create bigger and better opportunities than there ever were. And we're going to talk about some of the options here that are really compelling for these single store operators. The only thing I think that the takeaway is you don't want to do is nothing, is to try to just keep going the same way. And that catalyst can be really, really positive, I think, for the people who are willing to take action.
The one thing I'll add there is this isn't necessarily unique to our industry either, or even just the independent side. I know On the dealer side, we saw a lot of consolidation in the last decade, even maybe a little bit before that. A lot of manufacturers were driving that. Then you started to see more and more of that on the independent aftermarket side. And I think for all of the reasons you mentioned earlier, there are good opportunities out there, and you just have to know where you're at in terms of like where you want to go, which side do you want to do, and so as we go through this, we're going to talk through all of this. Now, let's first start by talking about what options there are. Say if you're that single location shop out there and you're maybe a little concerned about your future, what can they expect to come for them?
There are three really good options right off the top, and they all start with S. The first one is specialize, and really looking forward to diving into that one. The second is scale. Grow your rooftop count, grow that store count, create a scaled organization. The last one is to sell. And the M&A market for any of the subsectors of the automotive aftermarket that you and I are touching, there's a ripe market for consolidation where if the runway to invest in specialization or scale is not there, you've picked a very good time to consider an exit.
So can we talk through the three in a little bit more detail? Because I think, and let's start with specialize, because I think that's the most, I think as we talk about it, it's the first S on your list in general. But when we're talking about specialization, what are you talking about? Are you talking about a certain type of vehicle, a certain type of repair? What type of specialization are you referring to?
It's a pretty broad definition. It can be as generic as we're only fixing, your top 10 OEs all the way down to one, or, Germans, Japanese, American, anything like that, all the way up into sprinter vans, heavy duty, mid duty trucks, classic cars, exotic cars, things of that nature. Whatever a shop is really good at, I hope that they'll kind of consider doubling down on what you're good at. And the reason to specialize, there's a lot of them. It might be up top initially a little bit scary, taking a potential hit on your revenue, turning down opportunities that are trying to come into your door. But at the end of the day, if you specialize, you build your business around repairing a certain type of vehicle, doing it in a certain type of way, you're going to see not only will that top line end up better, or at least where it was, that bottom line is going to really move up. There's some real efficiencies in specializing on a specific type of vehicle. Something that I said, it was at the Auto Body Association of Texas show, and it was so funny. I said, I got to write this down. This was awesome. David can beat Goliath in this game, but not if they're fighting the battle the same way. You got to figure out where your advantage is, double down on it. You can't be all things to all people anymore. Vehicles are too complex. Go ahead and find out what you're good at and go all in is a really good option. And Kelly Logan with Rivian is someone who preaches this. I know Mike Anderson in our world, the biggest name, he's someone who preaches this as well. There's a lot of really smart minds who look at the future of the industry and see specialization as one of the key pillars.
Do you see ADAS kind of changing that in any regard, or maybe helping that specialization?
Absolutely. ADAS is an opportunity for some really compelling margins, and it's going to have the same kind of concept around specialization. You're going to want to buy equipment and do the training for certain OEs. And so if you want to use that as a part of your specialization, it's a great way to gain some more revenue, or at least keep it in-house. And then that's one that will really impact the bottom line if your facility is ready for it, if you can go ahead and acquire the proper equipment, and just as importantly, ensure your team has the proper training. It's a great option to kind of go that specialization route.
Might even be more of an argument to go the specialization route, right? Because that equipment is not cheap. And I think if you're doing it the right way, I think there was another session that you and I sat in at the Southeast Collision Conference where just talking through that business in general. And it is a little bit eye-opening to see, how different some of these setups are just to do a calibration. So, I think when we talk about it in a specialty capacity, it might even make the argument a little bit more compelling, right? Like that there is a need for better training in that one specific thing, or better equipment and tools for that one specific thing, rather than trying to cover everything through a broad scope.
100%. The same rule applies. You're not going to be everything to all people, whether that's collision repair, calibration, anything like that. You are going to want to specialize in the future unless you do that next step, which is scale. That allows for some flexibility with the type of work you do and how you go about it.
Is there any geographic difference between the specialization argument? So maybe if you're small town versus big city, there might not be as much of an ability to do the specialization, or do demographics not really matter?
They definitely matter. You're not going to want to be in small town Ohio fixing Lamborghinis, right? So you do want to take demographics into account. I was just on a podcast with Mike Anderson, and he pointed out a great thing where if you're considering specialization, most large paint companies are going to have some really good demographic studies for you. And you can see what the market can bear, what kind of the low hanging fruit for that specialization is, and give you a good sense of what you have. But if you're operating a shop and it has been around for a while, you probably have a pretty good sense of what you see the most of and what you're good at fixing and what you enjoy doing, how that bottom line can be impacted.
What a great point there, though, to as you're making a business case and for whatever direction you're going, utilizing some of those resources that are readily available for you that you might not have as a small business. There are a lot of big businesses that you work with that will have that information and really, in a lot of cases, freely give it to you.
We forget how big of an industry this is and how many powerful players we have. It feels small. Like I always say, it's a big industry, but a small world. It seems like everyone knows everybody. However, there are some massive, massive resources at our disposal as members of that industry, and taking advantage of those is prudent.
All right, so let's move on to the next S. What do you have for me
I'm
next?
going to skip scale and come back to that. I
Okay.
want to do that last, but I want to talk about sell and the question of why sell comes up. Certainly, if you're nearing retirement, it's a conversation that's worth having. To go ahead and specialize or grow, it does take investment. These vehicles are not slowing down in terms of their increasing complexity. That's only happening at a more and more rapid pace. So to stay doing what you're doing for a whole lot longer than you're doing it doesn't make sense. But at the same time, the ROI and investing in the new equipment, the new training, everything that it's going to require to effectively and safely fix vehicles probably doesn't make sense if you're nearing the end of your career. So the good news is there's never been a more ripe market for M&A out there. You have on the collision side, and we could talk for an entire episode about collision M&A and general automotive aftermarket M&A, because every service within the collision repair or the automotive aftermarket is experiencing some similar levels of consolidation. So it's really interesting. But in collision, you have the big five buyers. Many of them have freshly recapped with bigger private equity groups with mandates to acquire more and more. So while it feels like we've probably picked all the ripe fruit from a consolidation perspective, it's always really interesting to see from a national level consolidation viewpoint, we're about 20 to 25% consolidated. For as much as we've talked about it for the last decade plus, for it to only be there and for there to be so much runway left is fascinating to me. But I say that with some real confidence. Consolidation is not slowing down. Valuations really are doing good things right now for your single, maybe two store operation. They're staying pretty level. Haven't really done a whole lot in the last 2 to 3 years. At the high end with multi-store type groups, the 5, 6, 7 stores, there's a supply and demand issue that is driving those valuations through the roof. And it's a supply is lacking. There's only 40 to 55 plus store collision repair groups out there. And I know on the tire side, on the repair side, that number is shrinking because consolidation. But on the collision side, there's 100 plus private equity groups actively looking to get into the game. With private equity, for the most part, their capital is not that flexible. They need what we call a platform level investment to get in the game. And there's only 50-ish of those, maybe, if we're rounding up. So something's wrong here. Many of those aren't going to want to sell right now, too, for various reasons. So the valuations are really moving in a good direction. And you have a bunch of different types of buyers. And it kind of, the number of buyers in the pool goes up as you get bigger. If you're a shop doing $1 million out of 7,500 square feet, your buyer pool is probably going to be pretty limited. You're going to go to those local or regional buyers. Once you're to that $2-3 million mark, you're going to get a lot of interest from the national consolidators. And this is revenue. Once you flip to EBITDA and you talk profitability, once you're at like the 750K to $1 million of EBITDA mark, you're getting looks at from small private equity groups and things like search funds to get real private equity interest and be that platform. You're looking at a minimum of $2.5 million of EBITDA. And there's just not that many of those players out there. So that supply and demand issue is only going to increase, and it's only going to continue doing some good things for shop valuations. One last point, because this is a topic that I love and I could ramble on, so stop me here soon. Private equity groups look for industries when we're approaching some uncertain economic times that are recession resilient by nature. So much of the automotive industry is certainly collision repair, automotive repair, tires. These are things that, regardless of what the economy is looking like, you're going to need to go ahead and get these things handled. And so, not recession proof by any stretch, but recession resilient. And that's very attractive to some very smart people. So, to wrap that up, the thing that I like to point out is you have 100+ private equity groups. These are your Harvards, right? These are some really smart people just thrilled about the industries that we're in and chomping at the bit to get into. Has to make us feel really good about what we're doing day in and day out.
When you kind of reverse course here just a little bit, when you're looking at that onesie twosie shop that might not be there yet, and obviously they're looking at one of the options, what does it look like from a valuation standpoint for that person? Is that off of EBITDA, or is that off of give me an idea of how their valuations are coming in?
Different from buyer to buyer, but for collision specifically, it's one of the few industries that I've encountered that when it's kind of consolidator to single store, they reference valuations in terms of a percentage of revenue. And this makes sense when you think about it, right? They're not going to, uh, they're going to plug in their methodologies, their systems, their way of doing business. They don't care if you're getting above industry margins. They're going to plug in their margins to the same extent, but a little bit lesser. If you're getting slightly below their margins, who cares, right? They're going to be able to flip the switch, do their thing, and go ahead and increase those margins. So for single stores, kind of that $3 million of revenue down to $1 million or so, you're looking at that 50 to 60% of revenue range. Where the magic happens, and another reason private equity is so interested in the space, is once you get to that 7, 8, 9, 10, 12 stores, you could potentially get pretty well north of 100% of revenue. So there's something called a multiple
Wow.
arbitrage there that you can see why these groups are so interested in scaling.
It's really fascinating. And I think going back to your original point, it really depends on where you're at as a shop owner, right? If you are, nearing retirement and you don't want to take on that investment, there's good options to go that direction. If you are maybe a little bit younger and have more of an appetite for risk, you could go that other direction. And I think maybe what goes through the minds of a lot of people are just truly understanding where they stand at in that regard, and what their appetite for maybe risk is. But on the opposite side of that, you're kind of saying you're limiting your risk. Even, they're looking at it from a big investor perspective, but even from that person going from one store to two or two to three, there is maybe a little bit of a limitation on risk just because the demand is so there.
Oh yeah. Yep. It's nothing is risk free. One day perhaps the musical chairs stop, but it's a great opportunity. And I think a lot of people are recognizing more and more each day what that opportunity looks like. One other point I would point out is these three options, and we're going to get through these eventually, I promise, are not exclusive of each other, right? You can combine a couple of these options, right? So in the case of, and we'll get to scale here shortly, you can sell and scale, or scale and sell. And it's something that really has been a pivot of mindset for a lot of our younger industry kind of movers and shakers, the folks growing some really compelling organizations. The mindset shift has gone from we're not selling to private equity. We're partnering with private equity. We're keeping a big chunk. We're going to use their capital to pour some rocket fuel on what we have going on. And we're going to make that meaningful chunk worth well more than 100% of what I would have been able to do on my own. And so you're seeing that mindset shift, which is really compelling as well for a lot of folks who, if they partner with private equity, they want that second bite of the apple, right? That's the goal.
I feel like a lot of times whenever the private equity label comes up and somebody's not overly familiar with it, it can drive some level of anxiety, right?
Yeah.
Just because of the unknown. In your experience, how has that kind of come out?
So, and yeah, to set the stage, that is what I do day in and day out. I work with private equity groups as our buyers. I represent sellers and communicate with them a lot. But taking a step even further back, I spent 6 years working with my family's business in the automotive equipment space. And we had our own private equity partnership. And so I got to experience that from the seller side, which was really a great thing from an education perspective, from an understanding a seller's emotions perspective. I've lived it. There are so many different flavors of private equity. And for people who have a business that is attractive to private equity, they get the pick of the litter of what they want out of a partner. And there are partners who are purely financial partners. Here, love what you're doing, go grow. There's partners who kind of branching off of that want to do a roll up. They want to just acquire under your platform. There's other groups that want to grow organically and a little bit slower. There's groups who are the big New York heavy hitter types from a personality perspective. We partnered with a group out of Atlanta who were salt of the earth. We felt like we could go have a beer with them. And it's kind of depending on what's important to you. The private equity partnership can be a beautiful thing. When we talk about running a process, specifically when private equity might be the ultimate buyer, we talk about running that as like dating. And I think we've talked about this, you and I, in the past, but you really transacting with a private equity group is like getting married. You are married to this group for the future of the business. You want to make sure you know exactly who you're saying I do to when the time comes. And so I prepare people, hey, you're probably going to put on a little weight during this process because we're going to be having 8, 9, 10 really good dinners here in the next few weeks.
I feel like there's similarities to when we talk a lot about technicians and jobs, right? And understanding that they're going to the right place to work and how they're going to treat them. This is very similar in that regard, and really probably drives a lot of angst from that side of just knowing that it is a serious relationship and you have to take that process serious. What advice do you give to people in terms of understanding what they actually want? I think a lot of times we can say we want something, and then when the lights come on, you're like, oh, maybe I don't want that as much. How do you help them understand what it is that they truly want?
I love those conversations too. It's first is the easy one. It's what do you want for your business? What do you want your life as a potential private equity CEO to be? What do you want your life for your employees to look like? What do you want your legacy to look like? Are you trying to get this to 100+ store operation and become one of the big national players? Or do you like the idea of getting to 20 stores over the next 5 years or less? So thinking about and painting the picture of what you want the organization to look like, it's something I really encourage people to get introspective on and go ahead and really think and not be afraid to share that vision with prospective partners. And some are going to tell you, oh man, you want to get to 20 stores in 5 years? We want at least 100, not going to be a fit. Or vice versa. Wow, man, you got some big growth goals. We're a little more conservative than that. That's not us. That's okay. Those were not the right partner anyway. You find the right fit. There will be someone out there. If you have a desirable business doing a few million of EBITDA that is in the collision or automotive services space, you're going to get your pick, and you want to be picky about it. So feel free to share that vision. The rest is a little trickier, and it's a gut feel thing. When you meet somebody, how do you feel about them? Is the conversation cool? Do they pass the beer test? Do you mind getting a call from this person twice a week for the next 5 years? Because that's kind of what you think. So the gelling of the face-to-face communication, the cultural fit? Do you share the same values? It's very much like dating. And so much of that just comes down to feel and hopefully understanding what it is you want.
I'm going to steal that the wording that you just used for the beer test. I think that's something that everybody should use. That's a great one. I at some level, you almost have to feel like a translator between the two, don't you? Because you at some level are talking a different language to the PE groups versus the small business, or is it maybe not as much of a barrier as I see?
It depends. It depends. It totally depends on personality types and what that is. It's preparing as much as possible, really shaping where we want this meeting to go, what's going to provide the most value for each party. But certainly, especially once we start getting into due diligence and you got requests for all sorts of different financials and projections and all that stuff, that's really where we come in, and then just setting the stage and making sure everyone plays nice.
Is your shop looking to fill open positions or grow your bench of candidates? Consider adding WrenchWay to your recruiting efforts. WrenchWay helps shops and dealerships all across the U.S. find better qualified candidates for their service centers. WrenchWay Top Shop memberships are only $150 per month and include unlimited job postings on the best job board in the industry, a guarantee of 10 qualified applicants, and the shops choose who is considered qualified, access to connect with and help over 650 high schools and post-secondary schools, and much more. Learn more about WrenchWay's Top Shop memberships by visiting wrenchway.com and selecting the For Shops tab under the Solutions dropdown. Link is in the show notes.
Are we ready to go on to scale? Because I feel like there's going to be a lot of this one.
Yeah, absolutely. And yes. And so full disclosure, in the Carolinas Collision Association presentation, I didn't want to go on and convince all of their shops in attendance to sell. So my framing really was primarily focused on how to scale and how to take advantage of the tools that the big guys are using to grow and have real success. And that came out of, I don't recall if you were there, but CIC at SEMA last year. So November of 2023, I was speaking on a panel on consolidation on the collision repair industry. It was an hour-long panel. I think there were 5 panelists, and it was moderated by Frank Turlip with Opus. Fantastic guy, if you're familiar with him. And we're all kind of sitting up, just finished. Everyone, you could tell, was feeling pretty good about how it went. Thought that was awesome. And it's time for Q&A. And so we get a few people lined up, get some softballs, get some good answers out. You see Mike Anderson get up and get in line to ask a question. And the gravity that that man has in this industry in a room like that is pretty cool to witness. And he gets up, and we don't really get a pat on the back. We get a, man, guys, that was really focused on selling. We didn't talk enough about how independent body shops can use these tactics to acquire and to grow. And he was absolutely right. We didn't. And so put together the presentation with that in mind and saying, hey, 3 options, but here's the one we're going to spend the most time on today. And that was scale. And you can scale in multiple ways. I know of groups who have gone the traditional route where they're going to go and become multi-location. I've seen other groups scale into a campus, 100,000 plus square feet under multiple roofs all together. You've seen people scale via greenfielding or brownfielding new locations, and certainly acquisitions. And that's forever really been a strong flavor for the national consolidators. And the question really is, and we hit on it a little bit earlier, it's why scale? What's the benefit of scaling? And a really big one, outside of some of the operational stuff, and I want to touch on that as well, because there's some personality things that you want to evaluate more than just the business case for scale. But a big one is that multiple arbitrage where we talked about, where 1 + 1 does not equal 2, it equals 3 or 4. And the example I used was for collision repair, there's really only one group's financials that are publicly available, and that's the Boyd Group, owner of Gerber, publicly traded on the Canadian markets. And I had some numbers here. I'm going to reference some notes, and I apologize. At the time of that presentation, I was using their full year sales. They did $2.9 billion of revenue for 2023. We had adjusted EBITDA of 368 million and change for a 12.5% margin. And so I want to break that down. And so they're trading on the public markets for 193% of sales and 15 times EBITDA. So when we talk about these multiples, even for the bigger groups that are maxing out at 120, the moment that acquisition happens, they're worth at a minimum, 60, 70% more than before they bought them. So there's immediate value created in multiple arbitrage. And that works on a smaller scale as well. Of course, if you're buying shops at 50 to 60% of revenue, call it 3 to 5% of EBITDA, and you can sell for 120% of revenue, 10-ish times EBITDA, it's a very, very powerful tool that ensures 1 + 1 = 3 or 4.
So how do you start that process, right? If you are that, I'm going to start with single location and we can kind of work our way up, but you're that single location, you've got an interest in expanding and you're looking at the different options and opportunities available. Are you starting with a geographic market in mind if you're going to multiple locations and really trying to get demographic data from there to understand if you can have as successful of a business at a different location as you currently do? Walk me through that process a little bit.
It really depends on the business. For your standard single store generalist repair, that's really exactly it. You figure out where you want to be and you be opportunistic with your network. You figure out kind of some targets there. Acquisitions are typically, I won't say easier, but a quicker and surer path to some scale. When you get into greenfielding and brownfielding, there are some real opportunities for value creation, but you better be in a market that you feel confident you can staff it. You can turn on those sources of revenue, whether that's DRP, dealer relationships, or otherwise. There's more moving parts. So acquisitions are kind of how I think a lot of the single store folks look at growing. And I want to talk to you a few different ways to go about that, because I feel like in my early years of small business, coming from big investment banking where we were working on publicly traded deals, the path to growth via acquisition was not super clear. It's like, man, would love to buy that company. It'd be a great addition, but we don't have 5 million sitting around in cash. Of course, now we know that's not required. You can certainly fund some via cash, but there are a ton of resources out there for small businesses looking to grow. And I want to dive into that. Before we do, I want to talk about some other reasons to scale beyond the financial, right?
Yeah.
And it's part of where that personality comes into play and trying to assess your own strengths, your own wants for your business. But in theory, and it's counterintuitive, as you scale, you are able to become less involved in the day-to-day and kind of follow that old adage of working on your business rather than working in your business. Scale allows for the ability to plug in that middle layer of management or hire GMs or things of that nature that really allow you to focus on the higher level strategic stuff while folks are running blocking and tackling while you're focused there. You also have an increased ability to hiring top talent. And I think this is something you and I touched on a little bit on the Collision Vision, where you were a guest on. There's a sweet spot to me between the single store, the 2-store operation, and the national consolidator, where you have technicians or managers actively seeking to join these types of businesses. They have a laundry list of folks who are ready to come to work for them when they have the ability. It allows you to career map and career plan for people. It allows you to say, hey, we're part of a growing organization. You're getting in at a great time. So scale has a lot of really, really good things. And then lastly, we do go back to the financial piece. You become worth, obviously, a fair bit more than the sum of the parts.
The part you touched on there that really hits home with me is that ability to share your vision and showcase what could be, and maybe not having it be something that's already there, right? So like if you can sit down and talk with one of your employees and say, hey, listen, I know you have a desire to move up the chain and it might not look like there's opportunities right now. By being able to share the vision of growth and that you're looking to expand, I think it drives a lot of excitement, and it shows that there is a path for them to stay with your organization and have the ability to grow within those walls.
100%. And it's compelling, right? One store, daughters in the front office, owners, the GM. Where are you going to go? There's limited room to move up. When you have multiple stores, you're growing. You can really, in sharing that vision, get people excited about what you are all collectively building together. Additionally, right, bigger companies, they can afford more benefits, they can afford more competitive pay. There's an ability to really take the good of what the national consolidators can do and combine it with the good of that family run, culture heavy business where the owner can walk in and know everybody's name. Some combination and a bit of a cheat code there, in my opinion.
I think one of the big pieces, though, when I look at it, is making sure that if you're in that position as a single location, that you have the structure in place to be able to expand. I think we've seen it in the past where a single location goes to expand, doesn't have the proper infrastructure needed to expand. And so for that single location that's out there, be very intentional with looking in the mirror and saying, are we in a position, not only financially, but just from a structure and process standpoint, to have the ability to expand?
It's the biggest question, and it's the question that really only the operators can know. And it's part of who they are, what their skill set is. If they're good at fixing cars and not necessarily managing an organization, maybe scale's not right. If you don't have any processes and procedures in place, you're relying on the technicians to just kind of run the floor. Maybe we need to question scaling. There are reasons to not scale, and this is a line that I will use down the road a little bit as well, but there are plenty of reasons to not scale, but access to capital and financing, it's not one. And so you need to see if you think the day-to-day would be something that compels you. You need to see if it falls within your skill set to run a bigger organization than you have today.
So can we revisit the options for scaling, right? Say you are comfortable.
Yes.
Well, if I'm the one that's keeping us on track, we're in trouble. No, I think it is one of those things, though, as you look through this natural progression to where, hey, okay, we feel comfortable with the management team that we have, the structure that we've built, and now we're serious about looking outside to get that other location or expand what we currently have. What opportunities are there for that person to really look at scaling seriously?
It's a great question. And I have 5 different options here that I kind of highlighted in this presentation. And I'll do it here today with a much deeper dive on 2 of the 5, because I think those are the most compelling and the most timely. The first one is not compelling. It's not timely. It's write a check. Go ahead and use the cash in your business to fuel growth. Very few businesses are going to feel comfortable doing this. Most are not going to be in a position to do this. That's kind of you just got to check that box. Like, of course, if you have a bunch of cash, you can go ahead and fund some acquisitions. The second one that I'm not going to spend a whole lot of time on, traditional bank loan. It's a good option if you can get it. Traditionally, your cash flow of your business needs to be pretty strong to be able to do that. More and more challenging to get these days, and the interest rates are tough, right? And any of this you need to take into account. The interest rates are certainly changing the equations literally in a lot of cases. The last one that I'm not going to dive too far into, but it's an interesting one, is seller financing. You have a lot of people who are preaching about buying companies using seller financing, and that's fine, but you get what you pay for. Very few businesses are going to be willing to sell for 100% a seller note, but it's a great filler, right? It's a great thing to incorporate to make sure there is some level of confidence from the seller that, hey, the wheels aren't falling off. I'm going to be tied financially to this in some way. It's also just kind of like I said, really good filler. If you can get 10, 20, 30% covered or more on a seller note and figure out a down payment, it's a very nice way to fill in the missing pieces. Not a great way, in my opinion, to cover the bulk or the entirety of an acquisition. So those are the 3 that I just wanted to kind of brush over. The first one that I'm going to dive a little bit deeper into goes back to something we spoke about just a few minutes ago, and that's take on investors. Bring on private equity partners or family offices. There are thousands of these very well capitalized groups. Hundreds, at least, are interested in the automotive aftermarket ecosystem and service providers. There's a ton of interest there. And I want to go back to my piece on the younger, energetic founder with very big aspirations. How they look is, and many private equity transactions are this way, is I'm going to sell a piece, probably a majority of the company. And the example that I use is a 70% sale. You keep 30% of the new business. There's a lot to consider in terms of how that's funded with debt and equity, but the primary piece of that is you do that to take some real chips off the table. You're going to get some real value for that 70% of your business. But more importantly, you get, and I had a graphic that was a small circle with 100% and a really big circle with 30%, where that 30% is worth more than that 100% because you were able to use that private equity partner's financial resources, their operational resources. It can really take something that would have taken a decade to happen organically and get that growth completed in 3 or 4, 5 years, something like that. So for a small percentage of the groups out there who are of that platform size, really compelling. The one that I spent the most time on, though, was the SBA. And I think that's probably something you're familiar with. I think it's something we've probably talked about. But again, I'd reiterate that one line I like to use. There are plenty of reasons to not grow, but the access to capital piece cannot be one of those reasons.
It's great. And I think that's where a lot of people that are in that situation might not understand all of the options or opportunities that are available to them. And the fact that you can take that off the table as far as a reason not to grow, I think is really, really good. I want to talk about this SBA side a little bit more and what it means. I know it's helped a lot of people over the years, but what specific to your presentation was of interest with that SBA side?
It's a resource that way too many people don't know exists. And the SBA, the Small Business Administration, their goal, it's a government entity that wants to help people grow small businesses. And these are small businesses themselves, access to capital, or aspiring business owners, access to capital to acquire or build businesses. They have a program, the SBA does, called a 7A loan program. This essentially allows for individual businesses or individuals with good credit access for market rate, little less government funding, debt from the SBA up to $5 million for the business alone. It can get a fair bit higher if you include the real estate in that as well. And these are typically kind of prime plus 2 or 3%. So better than traditionally you would get from a bank for a traditional loan. Still a different ball game than it was 3 or 4 years ago, certainly, but up to $5 million that we all have access to buy a business that kind of meets those requirements. And their requirements are paying it back. Now, something to note, the SBA, while this is a very generous offer, all things considered, they are good at getting their money back. So the key thing to note here, and I know a lot of your listeners are not going to be afraid of this, personal guarantee is included in all of this. And so it's a real thing. It's not to be taken lightly, but for funding the acquisition of a small business or growth via acquisition for a small business, it is an amazing tool.
Can you talk to me about that personal guarantee a little bit? And the reason I say it is, like, even early in my business career, I knew what it meant, or I at least had a base level of knowledge of what that meant. But there's some real connection to that at that point, right?
Oh yeah. Yep, absolutely. Personal guarantee, there is very little that is off limits that the government would tie this loan to. And so you have plenty of examples of your home is tied to this, your vehicles, your business, if you're an existing business. So it is not to be taken lightly, certainly. I will say the SBA approval process is somewhat challenging. They're going to underwrite your deal. So to do it, not to take their mark of approval as a mark of approval, but you know, it has parameters in place that make sure you're not signing over a stupid deal. And the requirements for the 7A loan are you got to be buying or operating an operating business. It's got to be a for-profit. It's got to be located in the US, and it's got to be considered a small business under the SBA size requirements list, which is a link to the SBA website itself. And then the last thing, your personal credit is going to be pretty important there as well.
So how, in that scenario, how do you initiate that conversation? Is it going to, I think it's sba.gov, or what do you do to start the ball rolling in that regard?
Yeah, happy to send you a link for any of that. That was included in that presentation. So easy enough. Most banks, national or local, are going to have an SBA program. So I'd recommend talking with somebody at the bank level before going straight to the SBA. It's all going to be run through a bank anyway. So if you have a banker who you've worked with, you like, great. Otherwise, again, most banks are going to have a program like this. You also have SBA loan brokers that traditionally get paid from the banks, not from you. So there's not a commission that you're paying up a chunk or anything of that nature, where these brokers will have multiple relationships with multiple banks, and based on your parameters, your business profile, hopefully point you in the right direction to the 1, 2, or 3 that might be the best fit for you.
So banking relationships still very important as you go through that, and especially if you have one that you really like. I think those types of bankers are invaluable when you have that type of relationship, because they can really guide you through that. Now, I also want to look at the opportunity that's out there. I know this is something that I've seen over the years, in that the amount of shops that are, say the owner's 60 years old and doesn't have a real succession plan. Maybe nobody's in the family that's interested, nobody in the business that's interested. How big of an opportunity is there with that type of business out there right now? Because I do feel like there are a lot of people in that exact scenario right now.
Man, we call it the silver tsunami. Baby boomers are retiring at a rate never seen before in history. And there are a ton of opportunities because there are a ton of businesses that fit that exact profile. Now, a lot of businesses are not built to be sold. They might be too reliant on one person. There are some businesses that might be making money, but they're not really valuable to an acquirer. So that's something to really keep in mind. But the premise of the silver tsunami and the search fund rush and the private equity, the amount of capital that's raised under private equity, there's so many businesses that are going to transact over the next, call it a decade. Billions and billions and billions of dollars are going to trade hands via business sales over the next decade. And so consider playing a part of that. And I think the opportunities are tremendous out there. All of these options, by the way, how I like to end this conversation with your 3 options: to specialize, to scale, and to sell. My takeaway is there has never in history been a better time to be a part of the collision repair industry than right now. And zooming out, the automotive market, than right now. The opportunities are tremendous. These perceived headwinds, in my opinion, are really tailwinds. I think we're going to see some incredible things happening in our industry all the time.
I think that's really an encouraging message, right? That we do see opportunity in the industry. I think some of the advancements in technology are scary for a lot of people, and maybe they're anxious about what's going to come in the future. And what you're saying and kind of the roadmap that you're laying out is that it doesn't have to be that way, right? That there are opportunities out there. The last question I'll have based on that last conversation is, how do you tell if a business is too reliant on their owner from an outsider's view?
I love to know how much vacation that owner took in the previous year. I want to know what processes
That's
look
great.
like. When you're gone, what's happening? And if it's running without them, I've represented businesses where you do have the owner reliance issue. I've represented businesses that are very far away from Florida, but the owner is in Florida 7-8 months out of the year. You love to see that. The quickest way to destroy a business's value is for the owner to be too involved. And so if you're listening to this and that sounds like you, consider investing in building out a team and take yourself out of the day-to-day equation It's going to create value immediately.
It's almost unnatural for a lot of owners to hear that, right? Because the way we were raised was you work in the day to day, you work your tail off, and that's what builds a successful business. But in reality, you need to build a business that doesn't rely on you to have any form of value.
And there's a sense of pride. We all want to be very important in what we do. We all want to take credit for successes of things that we've built. And I see it even with the owners who are selling their business, who really have worked themselves out of the equation. There's this real push to sort of take credit or blame for things really they can take credit for because they built this business and they've now built a machine. And it's why private equity works too, from an operational perspective. The bigger a business gets, the less reliant on 1, 2, 3, 5 people it gets, the more stable that business is for the future, the more valuable that business is for the future as well.
I couldn't agree more. I just had David Boyes from today's class on, and we talked through the impact that training has on a small business and a small shop. And the fact that if you have a shop with 4 people that are working in the shop, and one of those people leave for vacation or training for a week, you lose a quarter of your productivity over the course of that week, a quarter of your ability to make any money for your business. Whereas as you start to scale up, I kind of view it. We had some rental properties for quite a while, and that was the same viewpoint we had there, where, you know, if you have a duplex and one side of that duplex is sitting empty, you're going to have a much tougher time. Or if, you know, every time you add more tenants, if you have a fourplex, and then you have just a broader array of ways that you can bring in revenue, I think you actually decrease your risk, because that isn't going to have the same type of impact that if you have a quarter of your staff missing on any given week, right? Like that can be really damaging. And honestly, if somebody has an injury or somebody leaves your company, you just lose a quarter of your productivity overnight. And it's I think almost more risky from that standpoint than it is to have a bigger business.
100%, man. It's why private equity has that minimum EBITDA for a platform. They want something that has those processes in place, the management team in place. It's sturdy, it's steady. They can add to it in terms of growth and not have to add to it just to put out existing fires.
I do have to give a shout out to my favorite business book ever, which is The E-Myth Revisited, because I think if you're an owner that finds yourself in that situation where you're struggling to get your hands around why you need to build out process and structure in a way that will make you attractive down the road, it's a great book to talk about just that, right? And I think the more you can absorb not only that book, but any podcast that's out there. Cole puts out so many good podcasts about this very subject, but there's so many different opportunities to learn about this via the internet or via a book. And I think that's just one example of one that really stuck with me early on. And I think those types of books maybe shift your mindset a little bit, right? Like it's a little bit different.
Love all of those shout outs right there. Appreciate the shout out to me, of course, too. One other piece of the ecosystem that is really helpful as well is networking in 20 groups too. There are people who have solved and are solving the exact problems you're going through right now. Go ahead and take advantage. Don't reinvent the wheel.
All great advice per usual, Cole. I can't thank you enough for joining us yet again. I think we probably could have talked for another half of day on this stuff. So I hope we'll be able to get you back on again in the near future. Always a pleasure, and just can't thank you enough.
Man, no, likewise, the pleasure is mine. Keep up the great work, both on the podcast and with what you're doing at WrenchWay. Really appreciate you and everything you do for the industry.
Appreciate you. Thank you. That wraps up another episode of Beyond the Wrench. If you liked this episode, please show your support by rating and following the podcast. You can also watch the video interviews on WrenchWay's YouTube channel. Speaking of WrenchWay, did you know Beyond the Wrench is managed and produced by the WrenchWay team? WrenchWay is an online community dedicated to promoting and improving automotive and diesel careers. We help technicians find the best shops to work at, and we also help auto, diesel, and CTE instructors get more support from local industry. You can learn more by visiting wrenchway.com.